Hi, good morning. Everyone, for people who are joining in from LinkedIn, from YouTube, from Twitter, we'll wait for a couple of minutes for people to join in, and then we'll start the session. So just give us about 100 seconds, and then we'll start. Thank you. Yes, we are good to go live now. I see few people who have joined in. So thank you again for to all of you for taking your time out on a weekday at 11 a.m. to join in. And of course, the person out here is worth all the time of yours. Thank you, Swarup, for joining in. It is always wonderful to interact with you, Swarup.
No, thank you so much for having me. It's an absolute pleasure to be with you, and I hope we have a good interaction now.
Absolutely. And I really hope all the viewers here will ask us some interesting, good, simple, complex questions so that we can make this session wonderful. So to start off with, I know most of the people know Swarup pretty well, but it's my duty to do an introduction. And he is the vice chairman and also the chief executive officer of one of the fastest growing, one of the top AMCs, which is Mirae Asset Investment Managers, and he's been in the investment management space for about 20 years, if I'm right. And overall, I think in the financial services for
Almost
about
30 years now, Anand. Almost 30
30
years.
years, yeah, 30 years now, 29 years and 20 years, right? Yeah, that's great, Swarup. So thank you so much again for taking your time out. I really would, want to ask you a lot of questions, but it is the time of viewers to ask us questions. So I have a few sort of questions that have come in from, because the moment people got to hear that okay, Swarup is coming, they started asking me few questions. So I have made a list of 4 5 questions which I've shortlisted, but as and when we get questions, I'll ask those questions live to you. So Swarup, I mean, I'll start with something which has, right, I'll just go back to LinkedIn and YouTube a bit and then come, so you may see me switching tabs here and there. But the larger thing is, I'll look at LinkedIn questions if they've started coming in, and then I'll start from there. Just 1 second. Okay, I can see some question. Okay, so the first question that I have is from on the sectors, right? So what is, maybe there's one more question. There's a most interesting question is on small caps, right? I'm sure after the short rally, I mean, short negative side of the markets on small caps, and thanks to SEBI chairman and the frothy valuations, what is your view? I interestingly, Mire launched a small cap fund recently, right, which is the momentum value fund. So, what is your view on small cap? How do you see things for small caps?
I'll answer that in two ways. One is from a market or investing perspective. Let's be very clear on one thing. The data availability or the possibilities of knowing more about companies is very top down. When you look at broad companies in the larger space and then you go down market cap, the idea that one forms about companies is far bigger in the larger space than in the smaller space. So the acumen needed for managing different market caps is very different, is my personal opinion. So
Okay.
somebody who can manage large cap does not necessarily mean can manage small cap, and can be vice versa also. So managing that sector needs a very different approach, needs a very different backend, and needs a very different analytic kind of a process.
Okay.
And funds have to build that process to manage that backend, right?
Right.
Over the years, we're just 16 years in India, so we've not got to building that backend yet. So we don't have a small cap. It's not an easy category to manage. And don't look at it from the last 1 2 year perspective when stocks have gone one way. We've had 6 7 years when stocks have not moved in that category also, right? So that is one. We, yes, as you rightly said, we launched a small cap, that's an ETF. So we formed an index which clearly filters out the three most important things that we think are associated especially with fund cap, small cap investing. The first one being liquidity, because some of these stocks are illiquid in the market, because the free float is the number of shares available in the market to buy and sell, is less comparison to the overall market cap or the stocks available in for that particular company. Essentially,
Right.
these companies are very promoter held, and hence the balance is a little less. So when you go to buy or sell, the amount available is less, hence the fluctuation of the stocks. Because when you look at price is when the buyer and seller meet, right? Since the
Mm.
limited pool of stocks available, the volatility of these prices can be there, right? So that is, liquidity is one major factor when it comes to small cap stocks. That is one filter. The second filter is obviously quality. I think recently I was reading somewhere that in the last 10 years or 15 years, only two small caps made it to the large cap space. The number of stocks which or companies which don't make it are far larger than the number of companies that make it. So it boils down to the quality, and there you have to reassess the balance sheet a little more. What can I say? Deeper than other parts, because you really have to understand these companies and the future prospects of these companies. Not all companies will make it in this space. You can't say that about large companies. Large companies have proven themselves and have risen the ladder, and hence they are in a very different space to this. So the second, as I said, was quality, and the third one is momentum. What we've observed, and data will tell you, that when there is a long period of lull, the stocks which cater to a momentum kind of a space in small cap tend to outperform the others. So when you meet the three and form an index, and the index is a rule based proposition for everybody, we felt that was a better way of launching a fund at this moment, since we have to build the back end on the small cap. So that's our broad stand. When you look at the run up in the last 2 years, because of the free float being less and the liquidity being less, it does not need too much money to make these stocks run up, is a reality. So the last 2 years have been great for the small cap space. The problem is not the price or the run up of the small cap. The problem which investors should assess or reassess is the allocation they have made to that space.
Okay.
If it is within their allocation, not an issue. And if it is with a good fund manager, not an issue. They know how to manage this space, and in case of adversity, they know how to manage it. So they will handhold you through any adversity that can come. At the same time, the investment horizon of small caps have to be far longer. I won't go into say I don't invest in small caps. It's my risk profile, or my portfolio requires 10 to 11% return. I feel that kind of returns can come from large and mid, so I've stuck there. Nothing against small caps. My mom, who's a retired professor, invests in small caps because she's a pensioner. She gets
Okay.
pension, so she can invest wherever she wants. I'm trying to create pension. So two
Right.
different investors does not make her a better investor, nor does it make me an inferior investor. It's catering to your own portfolio. Now, when you look at that kind of a perspective, you have to be clear how much to allocate. Now, allocation makes money, over allocation kills money. That's something which investors have to worry about if they are over allocated. And invariably, if you have a worry in your mind about the markets falling, you have to do
Mm.
two things. One is to check your asset allocation. Maybe you're a little over allocated, or maybe more money has gone there. So it's playing on your mind. Secondly, if you look at the last, whatever, since this discussion of the regulator coming in, the small caps would have corrected around 8.5 or almost 9%. If that is also worrying you, because that's the nature, it can fall 10, 20, 30% very quickly, right? If it is worrying you, then you need to reassess your risk profile. And risk profile assessment is a continuous process. What you're born with, risk profile is very different to a different stage in life. And if any of these 2 points are bothering you, one, you have to check whether you are over allocated to that space, and secondly, if you have the ability to take this falls, because the falls can be bigger also. Like in 1 year it can go up 50-60%. There's no reason why it can't come down 50-60% also.
Mhm. And do you see that happening? I mean, I'm not saying 50-60%, but do you see more pain in small cap?
See, one of the reasons for this rally was too much money chasing too little stocks. If the money flow can reverse, then this can happen. I mean, I don't know. Clearly, there's nobody who can predict what will happen, but it will depend a lot in this space, I would say, on money flow, because clearly the larger institutions will not buy this space as much as they do in the other spaces. So it is a lot of retail money which is there in this space, and if the reversal of flows can happen, then correction can happen. It's not
Okay.
impossible. But having said
Okay.
that, the kind of retail money that is there, and especially I speak for the mutual fund side, it will be very difficult to see a very adverse situation, because number of folios that have been created, especially through the SIP route, are large. Then you are talking about almost the entire space stopping or redeeming the mutual funds. That is highly improbable, is my personal opinion.
So the related question though is one is okay, liquidity affecting, but do you also see, at the end of the day, we are all taught and told that fundamentals matter more than anything else. Short-term price moves here and there. So do you see EPS growth? Do you see earnings growth in quality small cap companies? Of course, liquidity aside, but do you see at some point in time price will justify the valuation in the sense in terms of EPS?
For me personally, that has always been a question mark.
Okay.
Always been a question mark. I mean, and you have to reassess that space very, very carefully to arrive at those conclusions. Some will, but not all will. So when you look at it from a risk reward perspective, you should always assess it from a risk reward perspective. See, somebody told me very something long time ago that for 50 rupees to go to 100 rupees, you need a 50% gain. But that 100 rupees to come back to 50 rupees, it need a 50% loss, right? So which is easier? Fundamentally, there are good companies. I'm not saying there are bad companies. Some of the sectors, if you want to own, are only in small and mid. So some funds will be, by definition, be there in the space because they want to own certain some of these sectors. So from that perspective, it's about finding the right stories, right? You can't paint that entire sector in that brush, is my submission.
Got it. Okay. Okay. So one question that is coming at the moment is one question which I had is, I know it's very difficult to say, but is there a broad thumb rule that you can have so much in small caps? Is there a broad thumb rule that you at least follow? I know you don't have small caps, but is there a broad thumb rule? Because you said if it is in allocation, it is okay. If it is in
See,
a certain
at the end of the day, it's finally a factor of your portfolio requirement. If your portfolio requirements are such that you need that additional return, then you don't have a choice but to go down market caps. But we have seen that through thematics also you can get good returns. I'll give a small example. Last year, you compare any small cap to say the Fang Plus, which is a 10 stock global disruptive technology companies. Each company could buy out probably the entire market cap space of the small cap space in India. Went up almost 90%, right? Some broad themes can also give 30-40%. It's not in their good days they can run up. When a fund manager tells you, most of the fund managers will tell you a very simple statement: own a good company at a good price.
Correct.
When you are owning those companies, what you have to assess at a portfolio level, irrespective of whether you are in any fund, how much of it is good, strong companies. If they are good, fantastic, not an issue. If they are not and they are price driven, and today, on your mobile, you can check a lot of things. It's no
True.
rocket science to find information. See, today I read a very interesting thing is that no financial plan can be based on hope.
Yeah.
Yeah, a lot of this, that part invariably comes on the hope side also. नहीं ये चलेगा,
Chalega.
नहीं चला है चलेगा. Those are not reasons why one invests. But
Hmm.
one, clearly one has to have the risk profile to manage, be in that. And if your risk profile is great and your investment horizons are long, you should be there. I mean, fund managers in India are capable of giving you those stories. I would rather be with a fund manager in the small cap space than be direct.
Yeah.
Is something which I would definitely advocate. You can go direct in the larger stocks because there is enough information available. But when you go down the ladder of market cap, I
Hmm.
think you should go more with a fund manager. If you know, fine, back yourself. But if you don't, I would rather be in a fund manager in the mid and small space
And
than try to venture direct.
okay, okay. So yeah, that's a very very good statement because it requires a lot more fundamental analysis, lot more
It,
closer follow
it
up and all that.
and you have to be in the market 24/7, track those companies. You have to be very vigilant about those companies because if two have made it to the large cap, the story is already in front of you.
Yeah, yeah, yeah. I mean, that's a little surprising data, right? I thought there'll be a lot more, but you're saying only two
No,
are
it
becoming.
isn't. It is never more than that.
Oh, is it? Okay, okay,
The graveyard
okay.
there is fairly large.
Yeah, I'm sure there are a lot of people who have a lot of companies that have come down the ladder for sure, right? At least
Yeah,
small
I
cap
can
and
give
micro.
you all the data. The people who come down the data ladder is not as much as this graveyard. There are definitely people who come from large to mid, but very few would have come from large to small.
Large to small. Okay, 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 okay. But small to micro cap is quite possible.
Yeah, definitely. Like I said, the graveyard is pretty large.
Pretty large. Okay. So now you touch base upon Fang. There's one question
But
that
what
has come in.
happens is, on the contrary, a portfolio has say 40 stocks. These
Uh,
two stocks can give you the return. That's the potential of the overall portfolio. You don't need all 40 stocks to perform to give you the upscale is so large in some of these, the multiples are so large that if you get 5 6 good companies out of your 40, return possibilities are there. So that's the romance. That's the lure. And that's the whole thing that attracts people towards small caps.
yeah, yeah. Okay. That's for the on the return side, two companies contributing
Correct.
significant part of the portfolio. So, Sarup, related question I have is, you touched based upon Fang, right? We also have seen Fang Plus Plus. We have also seen that you as an AMC have a lot of ETFs, a lot of global funds in your portfolio. So while there's an enough and more coverage on US markets, right? A lot of people do cover it. It's not a big black hole, but these days a lot of people have interest in China and Japan. Of course,
Correct.
Japan did something for the first time in the last 17 years of raising interest rates.
True.
So that is something that is all around the news. So people are like, what is happening in Japan? Is it out of that big, a situation where it didn't have a bull market? Do we invest in China? Do we invest in Japan? What's your take? Because you also have China fund, right? So what's your take on China?
Yeah. See, finally, broadly, there is that, taking nothing away from the India story, which is intact and which will grow incredibly in the next 8 10 years. Fact is, we are just 3 to 4% of world market cap, right? We're below four actually. Almost 50% of global market cap is US, as you rightly said. So the first instance is to hold the dollar, and dollar is the strongest currency worldwide and will remain strongest for a long time to come. There is no competition to that currency. Let's be very honest on that one. So holding, or the merits of holding US is, I mean, I don't have to say much. As you said, the transparency is large, and everything is okay there. And some of the prices available last year were very fascinating. But if you really have to venture out and look at the markets, I think the Chinese market has been the bottom for the last 3 years, right? 3 years continuously. The second largest economy in the world is available to you at the bottom of the pyramid. If you want to own that market, this is probably the time when you should own it. See, all these countries, Japan, Korea, China, extremely different countries to what. One, I think their ability to call a spade is phenomenal. If things are wrong, they will cry it out that things are wrong. I mean, we are a Korean company, and there is enough discussion in Seoul that we are probably plateauing. I don't think the emotional India will ever recognize that the growth. The fact is that we are growing at 6%, and some times ago we used to grow at 9-10%. We seem to be very happy with the 6% growth. But simple fact is that 6% growth multiplied, this is basic mathematics, will not give you the desired result which we are discussing for 2047. We have to grow faster. This cannot happen in those countries. This the public on the ground will point out, ki, hello, 6% is not adding up to that. That's the difference. And that's why probably, they tend to achieve far quickly than we do, is a reality. I mean, I'm sorry I have to say this, but that's the truth. So when you look at these companies and some of the valuations which are available, it does merit a portion of your portfolio. As a fund house, earlier our basic objective was to, because we work in 17 countries and we have this incredible base of ETFs available globally, we had thought we would bring those stories to India, but the stoppage of global investing through mutual funds is posing a problem. So that is dented a bit, but I'm sure someday it will happen. And when that happens, we'll be very happy to give some great stories globally to the investors in India. And it's up to them to choose if it fits the portfolio or not. Our job is to provide a product. Now it's up to the investor to check whether it's right for him or her. Simple.
So do you like China in that case? Is
See,
it something that is?
investing is unemotional. Investing is mathematics. If the limits were open, I would definitely buy China now.
Okay.
It's just that our FANG Plus, because of lack of liquidity, is available at a little bit of premium, and that much of premium I'm not ready to give, that I'm not buying. I'm just making a very honest confession. But if the premium's narrow, I'll be the first buyer. I mean, it can't be available at this price for long.
Sorry. So now I'm confused. Is it about FANG or is it about China?
China, Hang Seng. We are discussing FANG. FANG, I'm
FANG,
done
FANG.
with. I bought the entire fall.
Okay.
I
Okay.
bought this upside completely. Got this upside completely.
Got it. Got it. Okay. So you mentioned about FANG. You mentioned about China. You also mentioned about small cap not being a part of your portfolio. Of course, FANG has done the job for you on
No,
your
I
portfolio.
make a disclaimer. I have nothing against small caps. Okay, it's just that my portfolio requirement is 10 to 11%. At this moment, I am a very paranoid retirement kitty accumulator. I don't want anything going wrong for that 10 11% projection of mine. And for that kind of returns, you don't need to take this kind of risk. I would rather get 11% a year on year than have a downside to that 11%, is where I come from.
So, but these FANG and other things, you play it as a different type of a portfolio,
As
not
a
the.
satellite part of my portfolio, very little part of my portfolio. My portfolio is very simple. Portfolio is 70-30, 70 equity, 30 is debt and alternates. Out of 70, it is a 40-40-20, 40 large cap, meaning large and Nifty 50 around that, 40 mid cap and 20%, out of which 10 odd percent is 10 or 15% is satellite in thematics, and 5% probably in alternates, is where I look at it. My wife exposed me to some art, and that's how I've started. She started. I just buy what she tells me. It's a
Right.
fascinating thing to be exposed to such incredible artists to India. And I have a little bit of money in some startups which I believe in, and they were very kind to make me early stage investor. So I've got that great fortune. So I participated in some.
Okay, that's nice. I mean, I think Mint did cover your entire
Yeah,
portfolio.
correct. They did.
Right. Okay, so now question related to that. So we spoke about core portfolio of yours. In fact, thank you for disclosing all these. I mean, I think these are great learnings for people. One is core part of your portfolio. Then there is a satellite portfolio that we are talking about, which is FANG and whatever you think is more
See, right
aggressive.
now my allocation is IT and banks in the satellite part.
Okay, so now that is where I was just coming, Swarup. So the question is, which you have already mentioned, but which are the sectors that you're or themes that you're generally positive about? And of course, you're taking it in your portfolio, but in general, you think, okay, these are the two, three sectors.
See, two things is when you look at investing, investing is for the future. And the market has run up in certain pockets. Call one has to make is whether those run ups will continue. If those run ups were to continue, then one should buy PSUs, which are hot stocks today. One should buy consumer discretionary, or some of the defense stocks which have run up phenomenally well. Or you can look at the future and be somewhere else. And our somewhere else is the private banks, which we feel are very, very structured companies and have not participated in the rally. We are always big favorites of consumption. We continue. We feel the consumption story of India is getting re-rated as we speak. Pharma clearly in the next 10 years will have a very good place in India. We feel some of the prices at which we get some of the hospitalization is still very, very cheap, and that can be re-rated with the penetration of insurance. This will change is a reality. So these would be our three major themes. I completely agree with that with the fund management team. The only place where I'm a little overweight, and then the fund manager probably, because they know more than I, they will probably start buying at a time when they think it is right. I am already having my play in the personal level on the IT side, because I feel those prices are already very attractive, and I don't have the ability to know more than that. So I invest in a fund, and through the fund, I'm a little heavy on banking and IT at this moment.
Banking, IT, and pharma, right? These are the three sectors that.
Yes, yes. Consumption has always been part of my portfolio, so that continues. So, see, when you look at the country will go ahead by some 4 or 5 core themes or sectors. I think the number one is infrastructure, which we are seeing playing out. If you come to Mumbai, it's like a treasure hunt. The whole city has been dug up, and I think they're finding some gold somewhere. But that's the infrastructure story in Mumbai. Across the country, new roads being built. I mean, I just came back from Bangalore airport yesterday. It's probably the best airport of the world. All that is happening as we speak. It cannot go ahead without a good, strong banking system. Banking is almost 30-35% of Nifty 50, and that's the private bank side is available at good prices. Again, bringing back my earlier statement of buy a good company at a good price. These good companies are available at good prices. Healthcare will be a big part of India going forward, and that's got has simultaneous correlation with insurance parallelly. So health and life insurance companies are now opening up. So that comes with that entire theme of not just pharma but healthcare. Consumption is the backbone of India. Some people will say manufacturing for the next 15 years, but if there is one seasonal story which will consistently drive India is consumption. The story to watch out for the next 15 years is the manufacturing. Finally, we are moving to manufacturing, and it's great that we do, because at the end of the day, jobs will be created through manufacturing is a reality. But it's a long story. It's a good 10-15 year story. What was consumption 15 years ago is manufacturing today. We have a great index on the manufacturing side. You should check it out. Whether you invest or not is a separate issue. It's a fantastic index which does not carry any financials. So very differentiated portfolio going out. So that's a story which, if one has to catch, can catch very early, is what we are saying. See, a lot has changed in the last post-COVID also. Telecom has got completely cleaned up. We're seeing revival of real estate, both in the commercial as well as residential. So a lot of things have happened where there are great value available, because in the last 2 years, market has been skewed on one part, which brings out great value propositions on the other side. So if you are a fund manager on the other side and you have money to buy, there are some great stocks to buy at some great prices.
Some great price. Okay. Now, what are the sectors to avoid? That's another question that has come. I mean, you have spoken
I
about
would
three.
avoid the ones which have run up, if you ask me. I'm already allocated there. So future allocation will not be in those spaces which have run up.
Okay. Okay. The related question that is that people are asking is, so let's say you're saying infra, and then there is also consumption, and especially on the consumption, right? So is it premiumization, or
Yeah,
because FMC
excellent question.
doesn't?
whoever asked this question, please thank the question, because that's where India is changing, right? India used to be this low and mid-level consumer, is going to become a mid and high-end consumer. So what used to be consumer now, consumption is divided into two parts: needs and wants. Needs are
Okay.
what we call consumer staples, which we are essential for your life, right?
Hmm.
Which is the daily, the toothpaste, rice, whatever you call it. The consumption which we do daily are staples, and the want side, which is where you spend for your lifestyle, is discretionary. We feel lot can happen on both sides, and as India progresses to this mid and high end consumer, which is already happening, that space opens up, which was not there earlier. It will take some time. Maybe it needs a little bit of patience for some investors, but
Hmm.
that's the space to watch out for.
So more about want
Lifestyle.
than lifestyle,
Yes,
right?
yes.
Yeah.
Want will take over. I mean, I was doing investor education in Pune recently, and I was asking the people there, and there's some 1,000 people in the hall. I had never attended something like this. I was attending. Do you get sessions where people call you to say how to spend, or encouraging you? Do they encourage you to spend more? Do you have any sessions like that? And why don't you have sessions like that? You get sessions that you should invest more. That's the sessions that you have, because you don't need any encouragement to spend. You do it
Yeah.
yourself.
So do,
And then look at the kind of money that we are spending post COVID on the discretionary side. You give me a Rolex today in India, I will buy it right now. You will not get a
they are not
Rolex
available,
today.
right? That's a problem.
Exactly. And you ask the shopkeeper for putting you in a queue, you have to know the shopkeeper very well to figure in the queue. That's what it is. That's the story of India now. And these watches are fairly expensive and they're not available. I can, if I can change this entire discussion only on consumer discretionary, and I can go on for the full day. But that is what happens, clearly when wealth starts accumulating at people's level, they try to fulfill their fantasies first.
Hmm.
And let's face it, we Indians have been economically a very suppressed country. We
True.
didn't have money. So once money starts trickling into the pockets, they start fulfilling their desires. And that's natural, nothing wrong with it. But that
Okay.
will propel this entire nation from an economic perspective.
Hmm. Okay. Okay. That's a fair. I mean, I also strongly believe premiumization is here to stay, and we are all expected to spend more than
It's
what
just
our
getting
parents.
started. I don't even want to compare you to South Korea. If I give you the comparisons, we are still nowhere in the picture.
Interesting. Okay. Okay. So in fact, so yeah, the point I was just trying to make is I'm pretty sure that whatever my dad spent, I'm going to spend a lot more than that. And of course, it raises his eyebrow. I'm a Marwadi,
But
right? So
yeah, correct. See, but here's the thing, the spending patterns will change dramatically. Somewhere between you and your dad, there will be some commonality in spending. But
okay.
between you and the next generation, they will break away like this. The next generation, which my son is
Hmm.
25. He is very clear he will never buy a house. He is
Oh,
extremely clear he will never buy a car. Extremely clear. Where will
okay.
I park, Dad? You actually in Mumbai, most of the parking lots are manned by people from my state. So I have almost a valet parking in Mumbai. He tells me, you have your guys parking for you, but why should I bother? Why won't I take an Uber or an Ola? That's their thought.
Hmm.
So they are replacing physical assets with experiences. Think about
Okay.
it sometime. So they will
Hmm.
travel more. They will go to restaurants more. Whatever. It will be more experiences than physical assets, which we believed in.
Got it. Okay, that's an interesting point. Now, the question that is coming is, so we have generally seen that most of us are chasing return. Most of the investors are chasing returns, and in the process, having not so great experiences in the longer term. Of course, so
True.
let's say a couple of stocks go up, and I buy it, and then it goes further up, and then it becomes a news, or it becomes a talk of the town when we meet at parties and all this stuff. But in eventually, they end up not making enough and more returns, right? So, what is the advice that you want to give to these? I mean, most of the investors who follow or chase returns.
See, I made this statement yesterday in Bangalore itself that the market has long-term investors making
Right.
short-term investments.
Okay.
Think about
Okay.
it.
Okay.
Yeah, we are long term. I mean, I've been in the market for 30 years investing, so I qualify as a long term investor. But we become short term investment. We pick up short term investment avenues because we chase returns. Today, if you have to invest places which have not run up. That's investing for the future. If you're going to buy trailing returns, which I mean that returns which have happened, then those belong to investors who are already there, not for you. Be very clear about it. We mutual fund guys then absolve ourselves by making the statement that we are not responsible for our past returns. We've given it to you in writing, right? It's like that cigarette thing, no, injurious to health or whatever. We've given it to
Correct.
you in writing. You have to take that to cognizance. And especially when some returns are abnormal in nature, you have to always question the abnormality of every return. What is so great that some category has given 50% in 1 year? You have to question. If you get the answer, please invest. Don't invest because some category has given 50%. Look for a category which is good, has not given. That's where probably you'll get the upside in the next 4 5 years. That's how portfolio is constructed. I'm not asking you to leave that category. If you are
Hmm.
invested, enjoy the ride. But your
Hmm.
fresh investments have to be calibrated in such a manner that you catch spaces which have value rather than spaces which have run up. That's a small correction you should make in your approach. Don't buy past. See, again, past returns for 1 or 2 years. See, I always make this statement: my fresh investment is inversely proportional to the
In the
category
same.
return.
Oh, okay.
My fresh
Okay.
investment is inversely proportional to the category. If the category return is high, my new investment will be less there.
Got it.
You'll go to a
Hmm.
category where the investments are investor funds have not, or the category has not performed, is yet to perform. You follow that simple formula over 8 10 years. I think your probability of catching the future returns is higher than getting caught in
Sure.
returns which belong to some other people.
Okay. I mean, a question there is, you're asking me to be contra. Not
Ha,
may not be.
see, market is contra every day. When
Yeah.
you
Okay.
think it's a great stock to buy, you will
Uh,
only be able to buy it if somebody feels it's a great stock to sell.
yeah. Yeah.
That is
Right.
how that deal happens, right? So don't ever be in this illusion that you bought something great, because at
Hmm.
that moment when you are buying, somebody is telling it's a great moment to sell. That is how that deal goes through. So market is contra every day in every trade.
Hmm. Hmm.
But
Hmm.
if you are looking at some, see, now suppose, just for an example, say the large caps we put will give 10 to 12% return. Just example discussion. Now some
Hmm.
categories giving that, fine, continue buying. Now suddenly a large cap starts giving 40% against a 12%, you have to question, ki boss. And then if that, finally it will revert to mean at some point of time. Are you
Correct.
catching it at the mean level, or are you catching it at a higher to the mean? If it is lower than the mean, please allocate more.
Hmm. Hmm.
That's how you should work.
See, mathematically it is correct, but I mean, this
So, but
involves a lot of.
Anand, this is what I'm doing mathematically. I told you my allocation was 40, 40, 20.
20.
40 should
Yes.
be in large cap, but because of this recent allocation, and I'm a salaried individual, I get money every month.
Hmm.
So I have this scope of cash flow every month. So this
Correct.
month, instead of that 40, 40, 20, I'm allocating a little bit more to the multi caps out of the large cap portion. Anand, are you there? Or
Sorry, there was a power disruption.
yeah. So because of that, maybe because the prices have corrected a little bit on the mid and small side, my allocation is getting a little bit more towards the multi cap out of the large cap because the prices have become better. Is my simple summation.
On the multi-cap, you said, right? Because of
Yeah,
the
instead
correction
of
that
going full mid cap, I'm taking the mid path of between large and mid, and then allocating a little bit more to multi caps that I normally would.
normally. Okay. So now the question there again is, discipline, right? We are all talking about more about discipline because you I think, of course, because you've been there in the industry for close to 30 years, you have the discipline. But if
No, I
I
didn't
don't have
have the
the
discipline. I didn't have the
initial,
discipline. Initially,
Acha.
I was a market timer. I thought since I was in the industry, I knew everything. And I
Okay,
lost terribly.
okay.
It's a reality. And because of those learnings, that I've
Hmm.
become completely mathematical. I don't look at the markets. My allocation will tell me the market. Suppose I'm 40% in, say, large cap, and the large caps have gone up 40%, means that 40% is 44%, or 50% already because of valuation. So either I sell some of it, or I replace that additional 10% by other assets. That's how I do. It's pure mathematics. It's got nothing to do with any thought process of mine. The allocation grid defines which is my next purchase. If, say, by virtue of the run up of the market, my equity has gone up by, say, because the 70 would have gone up another 20%. So 17 to 2, say 140 would be 84%. I will then work on bringing it back to normalcy by allocating more to debt. At this
Got it.
moment, I am continuously allocating to debt because that data has to come back to 70/30. I don't sell in the market, I rebalance in the form of adding more in the other assets.
So
I
you're
don't
more
redeem.
monthly rebalancing, not rebalancing, monthly.
No.
Uh,
See,
made,
we are lucky that, at the end of the year, if we've performed a little bit well, then we also have an incentive or a bonus pool which comes to us. So
Good.
that gets into the rebalancing phase.
Got it. Got it. Okay. Okay. So now, I mean, I really like the fact that you're opening up on your portfolio, because that is like a live example. Otherwise, it's in general. I've seen people just coming and talking about general gyan, saying, मैं ये
No,
होना
I'm just
चाहिए.
talking about what I've learned. See, it takes years to become an investor. It takes years to assess your own risk profile. It's very difficult for you to sit with no small cap when people are talking only small caps. But I'm okay. I have no issues at all in my life because I've seen if you deviate from the risk profile, that's when you start making mistakes. And I don't want to make mistakes anymore because I don't have that much of time left because I have some 18 years of earning as salary left and I can't goof up anymore.
Okay, 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 okay. That's good. That's an interesting one. So one other question now, it's a little getting a little different. So the question is, about emergency corpus. I'm just reframing it. So people do keep emergency corpus. Someone keeps 6 times the monthly earnings or 12 times the year earnings. So the question that has come in is it okay to keep, because emergency corpus is used only in case of emergency, which is once in 3 years, or sometimes it can happen once in 7 years, 10 years also. So is it fair to not to invest them in highly liquid debt funds? Should one look at either balance funds or maybe large cap equity? Is it fair to do that?
See, as long as the appreciation part of your
Hmm.
portfolio is more than 6%, you should because you can anytime redeem from there. I would say whatever is your emergency corpus depends on individual to individual. 3 months, 6 months, 1 year, choice is yours. Suppose that 1 year requirement is say 5 lakhs, just for discussion.
Sure.
If that 5 lakhs is available in appreciation somewhere, it's fine. I mean, you can always redeem that, and as long as you're not using your principal is a basic rule I follow. Earlier, I used to have a very substantial uh, 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 emergency corpus, but then I upped my medical insurance a bit to take care of that. And then right now, because I've been investing in equities for such a long time, that my appreciation is there for me to use that at any point of time. And recently, the credit card, what can I say, the limits are fairly decent for me to swipe it anywhere in any hospital. Mostly the emergencies are hospital needs as we speak.
Hmm.
So
Hmm.
you should have a good insurance. If you don't want to keep a cover, I mean something aside, please clock in your medical insurance substantially and use good credit card limits at the end of the day. So it's your call. I used to have earlier, but now with the increment of my equity portfolio, I have reduced it and I've used these two routes to supplement them.
Okay. Okay. No, no, that's a fair, I mean, very interesting point. You mentioned that you're using, because your corpus returns are high enough. you are using that as an emergency. Is that what you're saying?
Yeah, I mean, I'm invested in the market for a long time. So whether it's forget me, my mom, my dad, my wife, and hopefully in the next 2 3 years, my son will have that kind of appreciation. My
Okay.
mom,
Okay.
my parents have. Okay, clearly for retired professors, if someday if you check with them on their portfolio, their incremental earning, not from principal, but their appreciation is fairly decent.
Okay. 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 That's an interesting point. Okay. Now there's one question from LinkedIn, Niksha, who's 20 years old. Her question is, she's
Yeah.
been investing in fixed deposits and gold, but I mean, of course, I'm sure people are telling her to invest in equities. What are the, for a newcomer like her, what are the risks involved, and is it okay to do it?
See, first of all, Nisha, you have no idea how fortunate you are that you are 20 years old. You're so young, and you have a great life ahead of you. See, very, very clearly, the India that you will stay in, and I assume you are in India, uh, is not going to be as cheap as it was for me or my father. Life is getting a little expensive, so please realize at your age that you're going to need money. And I will supplement that by saying you'll need a lot of money in your life.
Right.
And it's not about what you earn; it's about how you invest. That passive income sort of grows. Don't underestimate any money invested. From your perspective, I'll leave you with one thought. How you invest is your business. You should talk to a good advisor. Maybe Anand's the right man for you. But follow one fundamental rule: all your money should beat inflation. That's where you start from. The inflation, suppose in the country is 6%, that means your 100 rupees invested in a bank FD or wherever should at least give you 106 rupees at the end of the year for that money to have its same purchasing value. If it is less than 6%, the problem or the mistake which people make is they assume it is safe, but financially it is not. You are actually losing money. So that's point number one. Your 100 rupees has to be 106 rupees for your 100 rupees to remain 100 on the value of that money. Second, gold is a good asset class to have, but gold is a hedge against volatility in the market. These are two traditional forms of investing which worked great earlier because the interest rates were very good earlier. I'll give you a small example, and I say this with the permission of that fund house. I got married in 1996, and typically I come from Calcutta and Bhubaneswar, where you cannot imagine, especially in Bhubaneswar, you cannot imagine how much gold we all have. In my younger days, the amount of gold I used to wear, I could give Mr. Bapilari a run for his money also. If we didn't have gold or we didn't wear gold, we had no social standing as men. Think of the
Okay.
women. Okay, think of
Okay.
the women. So, like a typical Indian, I went and I got married in 96. So, I went to buy gold for me and my wife. My wife doesn't buy gold, and that's one of the best things that could have happened to our married life. Uh, uh, and whenever you buy gold, no, it's expensive. It used to be 5,400. What is the gold value today? 60,000, right? 60 odd thousand. So gone up 10, 11%. In that November, a fund was launched. In those days, it was called Reliance Growth Fund,
Yeah.
right? Please, I would request you, now it's called Nippon Growth Fund, right? Anand? Please go
Yes.
and
Yes.
check
Nippon.
the NAV of that fund. It was launched at with 10 rupees in 96. What is that? It's a homework I give you. So
Hmm.
investing in gold is fine, but if I would have bought that instead of my gold, my story would have been very different, right? So some amount of gold is definitely okay as per your allocation, but what I see in you is absolutely no exposure to capital markets. Now, India will go from say 3.5, 4 trillion to 6, 7 trillion in the next 8, 10 years. There's no doubt or debate on that one. The best way for you to enjoy this growth of the country in your personal life is through the capital markets. That's the best way to own this growth for yourself. and the capital markets is through the equity route. Now, at your age, I would first ask you to really study a bit. Google whatever is in your mind. And the best way about your Google is your question is asked by God knows how many people in the world. Just Google your
Mm.
question. Answer, you'll get a lot of answers. After that, ask yourself, why do you want to invest? Because your why is very related to your life. Make your investment journey a part of your life journey. Through your investments, try to achieve your life requirements. After you answer these two, then come
Mm.
to somebody like Anand, and they will have the solutions for that. Not all money
Okay.
should go to equity. Depending on your need and your want, your portfolio will be formed. And the portfolio will be formed by a composition of debt, which you are doing a little bit of FD, some part of gold, which is there, some part in equity. It's a mix as per your life requirement. But what is your life requirement? You have to assess. After you assess that, please come to Anand. He will then build a portfolio for you. After that, don't leave Anand. Every year, sit with a review. Ki, hey, here was my requirement. Where are we? Because the markets are dynamic. If you are on track, great. If you are not on track, make some corrections. So the review of the portfolio and rebalance of the portfolio is very important. And do this. By the time 30, 32, I am also there in the market. The other part which you have to understand is, as a woman, you will live longer than men. At 20, you have to prepare for at least 65 years more of life, at least, maybe
At
70.
least. Mm.
At least 90 is what you'll have to prepare for. So from 20, you'll probably work till 60, which is 40 years of your life, to survive another 40 years without active income.
Mm.
So these two factors you have to keep in mind and build, because the retirement requirement is completely, I would say, not unknown, but is not even thought of by most people I meet. They're clueless as to the kind of money they will need post retirement. And post retirement, your only friend is money. Let me tell you. I'll be very honest on this one. So you're at this great age of having the ability to build a good corpus for yourself, but start now.
Okay. Okay. I think that's a detailed one, Nisha. Thank you for the question. Vishal, I think for health insurances, maybe so the question from Vishal is how do we talk about health insurances? Maybe I'll skip that question and do a session on that. Is that fine,
Yeah.
Swarup? Right? Okay. Now I'll go to Vivek's question. What is the percentage allocation to thematic mutual funds? I mean, that is, I think I had asked you initially. We all know that there are a lot of segments and industries that will grow more than the markets in general, but also there is a risk of concentration, right? So how do we decide what is a good allocation? For me, I know you would say needs, but is there any formula or anything that
No,
you
for
generally?
me, it is 20% of my portfolio. Nearly 15% of my portfolio is in thematics. And see, when we launched our healthcare fund some four, almost 5 years ago, that 10 rupees is almost 25, 26 rupees today in 4.5 years. We feel in the next 4 or 5 years, the uptake from here will happen because the healthcare need is India. See, there's a small difference between sector and theme, which I
Right.
think when your question is alluding more to the sector, the sectors are cyclical. Sectors have their own dramatic ups and downs, but themes are subset. Sectors are subsets of themes, and themes grow in a secular manner. When we launched the consumption funds some 12, 13 or maybe 14 years ago, it used to be practically FMCG.
Hmm.
In the earlier age, I give you a very interesting example. The tech funds were launched by the industry in the early 2000, 2001 or 2, and it went through a dramatic crash. So one of the funds, I don't want to take the name, had taken a particular bank in the tech fund, and the rest of us who didn't have that fund cried foul. Arey, because of lack of return, they've started taking banks. In 2002 or 3 probably, they released a note saying that how banks will become tech plays. And that's when I
Hmm.
realized that I had opened my account then with a particular private bank, and I had not gone to the bank to open an account the first time. that those were happening. Even today, I don't go to the bank for any requirement of mine. My bank is the phone. It is a tech play. So, simple point I'm making is the themes grow exponentially. We have a very interesting ETF called the social media ETF in the US with Global X. They launched the social media ETFs when Facebook was not there, not IPO. Facebook was not there. Think of the thought of the person who thought that the social media will become like. So themes are very different, and when you sit early in a theme, you enjoy the ride. I've been enjoying the ride in consumption for over a decade now. I will enjoy the ride in healthcare for the next decade. I'm beginning to get into IT because I feel these are great prices. But these are growth. Like suppose we have a very interesting global AI portfolio. Now,
Hmm.
no company, irrespective of any industry, can go forward without an AI engine sitting on top of them. So these are diversified portfolios. Sectors are not diversified. So please differentiate between the two.
So sectors are subsets of themes, is what you're saying. And what I learned from you is sector play can be a little more cyclical and then short term, I mean medium term
Yeah.
rather, and themes can last for years and decades also together.
I mean, look at healthcare. No, healthcare is not pharma. Health can be fitness also. And today, let me tell you, can you be fit in that black cycle that used to happen earlier? You have to have a
Hmm.
different cycle for it. You have to have a
Hmm.
different costume for it. Your sneakers have to be different. There has to be music. Otherwise, you don't become fit. That's a
Hmm.
reality. You won't be caught dead in that white Keds that we used to wear in our childhood, still available in one of the leading shoe shops. But if you run
Right.
in them, you will not become thin, is how it plays. So the the thematic play is a very broad play.
Okay. So now then the question then is how much should be is there a rule that you follow? How much should be, like you said, 20%?
Yeah, so the rule is very simple. The core part of your portfolio has to have strong companies, companies which have, kind of shown their mantle in the market or whatever. That's the core part. You have to decide how much that core part is depending on your risk profile. For me, that core part is almost 40% of my portfolio,
Okay.
right? I don't compromise on that at all. 40% is sacrosanct. It used to be 50 earlier, but what happened is some of my lifestyle requirements went up a little, so I diluted that by 10%. But below 40, I will not go. Another 40 then goes into mid caps. I feel mid caps is a place where there are strong companies, and that segment is working well in India. Smaller companies which will become large, and I will take that journey. And I do it completely either through a fund manager or through index, nothing on my own. I have no ability to pick a stock. Then the rest of the 20 is where I play satellites, where I'm looking through that to give that kicker of probably a 1% to my overall portfolio. Between mid caps and satellites is where I play that alpha game of my overall portfolio. But I don't go beyond 15% in that at all. 5% is for some other thing, but 15%. Let me see next year if some of the large, we're looking good at manufacturing. If manufacturing takes some speed, maybe that 15 can go up to 20, but not beyond that for me. Now, what's that mix? You have to decide on your plan with your advisor or distributor.
Okay. Okay. Yeah. So while we also generally believe 20 is good, but yeah, it depends on the person and the requirement. Like
Correct.
you have clearly noted down your requirements. So I think we are running short of time. While I can continue this discussion, Swaroop, for long enough period. We are short on time, and we are just about to close. Any parting thoughts? What is your view for India in general for the next 5 years? Like you already mentioned to Niksha about the things that you are looking forward in terms of growth. Any parting thoughts before we end it?
It's something which we're very fortunate to be in this country at this moment of time. Earlier, India was a very, I'm not comparing, this is not a political statement at all. Please don't confuse me for that. The
Okay.
fact that this country is maturing at an economic level, and it's a time game more than anything else, is a reality. Today, post COVID, this country has a far more broader play than it was pre COVID. If you look at data points pre COVID and out post COVID, it's like this country has been reborn. right? You can see in front of your eyes from roads being built to different kind of infrastructure in front of you, the kind of consumption that you are making, cars that are coming to you, the opportunities that are there to travel, anything that you see are looking extremely different from what used to happen earlier. And yesterday, I mean, I'm stunned. I keep on talking about the Bangalore airport, and I'm fairly decently traveled. Let me tell you, self confession, to say that it is the best airport in the world.
Wow.
You go and check any airport, even the Singapore so-called airport does not compare to this anymore. This is how it's looking up. Next 5-7 years, it will be a phenomenon. So these things, because we are creating them new, are happening today. UP has 9 airports.
Mm-hmm.
So these will change the entire concept of the country. Hence, there is a risk to investing. There is a risk to not investing.
Right.
There is a risk to investing in equity. There is a risk to not investing in equity as well. The risk to not investing in Indian equity is fairly large.
Right.
This 10 years will see a dramatic upside from 4 trillion. You're talking about doubling an economy here. Means this country
Mm.
will again be remade. So, some of you who have missed this opportunity so far, do not miss this opportunity. And please, for heaven's sake, don't leave the market. People who are invested in this market, do not leave the market. And if you want me to come back with Anand every year to rehearse this statement, I will be very
Right.
happy to do it on a yearly basis to rehearse this statement.
Okay. Well, that's wonderful, Swarup, and I really thank you again for taking the time out on a weekday, again, right in the middle of markets and all that. Really appreciate you taking time, and I really hope we do this at least annually or so, right?
Thank
My set of people will really like it.
Thank you.
Thank you so
Thank you
much.
so much. Really
Thank
appreciate
you,
it. Bye bye.
everyone, and we'll see you next time. See you. Bye bye.